Hey everyone, and welcome back for another deep dive. You've been digging into the Fed's recent interest rate cut smart move. We're here to help make sense of it all and highlight what you really need to know.
And what's really fascinating here is this could mean a big change in the Fed's approach.
Okay, so not just a minor tweak, we're talking a potential game changer.
Yeah, potentially. I mean, think about it. We've seen the Fed battling inflation for over 2 years now, right? Aggressive rate hikes all the way. This cut to the interest rate, it suggests they might be seeing inflation finally cool down.
Yeah, inflation has been the big worry for a while now.
And this 0.5% cut might not sound huge, but it's a pretty strong signal. Like I said, they've been raising rates to get inflation under control, and, well, it seems to be working. Remember a year ago, inflation was a scary 9.9%.
I try to block it out. So good to see it down at 2.5% now.
Exactly. This rate cut, it's like a signal they're shifting gears, moving from just fighting inflation to, well, maybe preventing a recession.
So instead of slamming the brakes on the economy, they're easing off the gas a little.
Perfect way to put it. But of course, just like any other big economic shift, this rate cut's going to have different impacts on different
For
things.
sure. I bet our listener right now is thinking, okay, but what's this mean for my investments? Let's get into it. We're looking at data going all the way back to 1929 for this, which
Yeah.
is wild. I had no idea we even had records that comprehensive.
Right. And it's really interesting to see the patterns. A study by Schwab looked at stock market performance after similar rate cuts in the past, and get this, they found the S&P 500, the main benchmark for the US stock market. 86% of the time, it saw positive returns in the 12 months after a rate cut.
So, historically speaking, cutting rates is good news if you own stocks.
More often than not, you could say that. But, and there's always a but, right? There are always exceptions.
Yeah, trying to predict the market is a fool's errand.
You got it. And the thing that can really throw a wrench in the works is, well, you guessed it, a recession. Economy shrinks, stock market usually follows.
Makes sense. Companies make less money, their stock prices drop. Domino effect.
Exactly. And looking back during recessions, the stock market's seen an average loss of 15%. So, yeah, rate cuts can be good for stocks, but they're not a sure thing.
All right, got to weigh the potential gains against those risks.
Yeah.
I mean, right now, the stock market itself is predicting an 8% chance of a recession in 2024, but that jumps to 56% by 2026,
Well,
so something to keep in mind for sure.
absolutely. Okay, let's bring it back to this rate cut, though. Lower interest rates usually mean companies can borrow money cheaper, right?
Which is huge, right? Lower borrowing costs could mean higher profits for those companies.
You got it. And higher profits often mean higher stock prices. So this rate cut, it could start this ripple effect that boosts the whole market.
We've actually seen that happen before, haven't we?
Oh, yeah, definitely. Back in 2019, the Fed cut rates and stocks went up over 15%. Then, after the emergency rate cut in 2020, the market surged over 60%, even hit all-time highs.
Okay, that's a pretty convincing argument for rate cuts, at least when it comes to the stock market.
It is. But gotta be careful. It's never that simple. Context matters. Think about the dot-com bubble, the 2007 crisis. Those times, rate cuts alone couldn't fix everything.
Right. Other factors going on that went way beyond just interest rates.
Exactly. Always got to look at the whole picture.
Okay, so we've established this rate cut could be good for the stock market overall. But let's get granular. Not all stocks are the same in this situation, right? What about dividend stocks, for example?
Ooh, now that's an interesting one, especially if you're interested in passive income, right?
Hit me with it. I'm all ears.
So, research from Schwab shows that sectors that pay dividends, things like utilities and real estate, they tend to do really well when interest rates are low.
Interesting. Why is that?
Well, these companies think about the infrastructure for utilities or the development costs in real estate. They often borrow a lot of money to operate. So when interest rates drop, their costs go down, which can lead to bigger profits. And that means, you guessed it, more dividends for investors.
Win-win for those companies, A&D, the folks who own their stock. Now, while we're talking about investments that are popular with income-focused investors, let's shift gears a bit and talk about bonds.
Good call. Bonds are super important for a diversified portfolio, especially in times when the economy feels a bit shaky.
Bonds, though, I don't know, they have a reputation for being a little, how do I put this, quieter than stocks.
That's one way to put it. It's not like you see headlines about bonds making these crazy price jumps overnight, the way some of those high-growth stocks do.
For sure. But that's kind of what people like about them, right? They're seen as this safer bet, something stable to turn to when the rest of the market's going haywire.
You're right, definitely. And the key is understanding how those bond prices react to changes in interest rates, like this recent cut we're talking about. It's actually an inverse relationship, which can be a little confusing at first.
Okay, so pretend I'm back in Econ 101, haven't quite grasped the whole bond thing yet. Break it down for me.
Imagine you bought a bond, say a while back, that's paying you 5% interest. Got it.
Got it.
Now, say interest rates drop across the board and new bonds are only offering 4%. Suddenly, your bond, that 5% one you snagged earlier, looks pretty sweet to other investors.
Right? Who wouldn't want that extra 1% return, especially these days when every little bit counts?
Exactly. So those investors, they might be willing to pay a premium to get their hands on your bond. That demand drives up the market price. Basically, as interest rates go down, the price of those older, higher rate bonds tends to go up.
Got it. Okay, that makes sense. So for bondholders out there right now, this rate cut could mean their portfolio gets a little boost.
Definitely a possibility. Of course, like everything else in the market, there are other factors at play, but bonds are a fascinating piece of the puzzle.
They really are. All right, I'm ready to shift gears again. Time to address the elephant in the room, or maybe the crypto elephant. So we got to talk Bitcoin. Everyone wants to know, what does this rate cut mean for the world of crypto? It feels like there's a lot of hype, but not always a lot of, clear answers.
Bitcoin definitely knows how to grab people's attention, doesn't it? And you're right, it's surrounded by so much speculation. But if we look at some historical parallels, maybe some recent market trends, we can start to get a clearer picture.
I love a good history lesson. Lay it on me.
Okay, so let's think about gold for a sec. Gold's kind of the classic safe haven, asset-like bonds. It gets popular when the economy is uncertain. Now, you want to know what's been happening with gold prices in 2024? They've shot up, like way up 25%.
25%. Okay, that's got to be significant. What's fueling that kind of growth?
Few things, actually. There's the inflation worries, some geopolitical stuff happening, and yeah, you guessed it, falling interest rates. Remember how we were saying lower rates make things like gold more appealing to investors?
It's all connected. So where does Bitcoin fit into all of this?
Okay, here's where it gets interesting. Gold's market capitalization, basically the total value of all the gold in the world, it's gone up by, get ready for it,
Yeah.
$3.7 trillion this year alone.
Trillion with a T. Okay, that's a lot of zeros. Need a minute to wrap my head around
Yes.
that number.
Right. And here's the kicker. That $3.7 trillion jump in gold's market cap. It's 3.3 times bigger than the entire market cap of Bitcoin.
Whoa, okay, so gold's still the undisputed champ when it comes to sheer size.
At least for now. But some analysts, they see that massive difference and think, hey, this means Bitcoin has huge potential for growth. Think about it. If Bitcoin just mirrored what gold's done this year,
We'd see some crazy numbers.
potentially, we could be talking about Bitcoin jumping from its current price, around $558,000, to wait for it, $174,000 per coin.
Okay, even though I try to be cautious about the whole crypto thing, you got to admit that kind of potential gain is pretty hard to ignore.
Definitely grabs your attention, doesn't it? But a little cautionary note here is always a good idea.
Always, always. What do people need to keep in mind?
Right, so those potential gains are exciting and all, but Bitcoin. Notoriously volatile. Its future is riding on so many different factors, what the Fed does next, regulations, even just the general mood of the market. So this rate cut, it could create a good environment for Bitcoin, but no guarantees.
Right. With any investment, especially something as unpredictable as crypto, do your research, know what you're getting into, and definitely don't invest more than you can afford to, lose.
Couldn't have said it better myself. Okay, let's come back down to earth for a minute. Enough about potential crypto millions. Let's talk about what this rate cut means for your everyday finances. Loans, savings, that kind of stuff.
Yes, let's get practical. Those are the things that impact everyone day to day.
You got it. So the impact on borrowers versus savers, it's like two sides of the same coin. Let's start with the good news for borrowers. Rejoice. Lower rates are probably coming for everything, from mortgages and car loans to even credit cards.
That's what people want to hear,
Yeah,
especially these days. Every bit helps.
for sure. So if you're thinking about buying a house, refinancing now might be a good time to look into it. On the other side, though, for savers, this might be a bit of a bummer. Get ready for the possibility of lower returns on those savings accounts and CDs.
Yeah, it's always a little disheartening to see those interest payments shrink, even if it's just a bit.
Definitely. But there are moves you can make, like maybe think about locking in some of those higher rates while you still can. You could look into longer-term CDs or explore other savings options that might have a slightly better return.
That's a great point. Being strategic is key, right? Especially in this kind of economic climate. Got to make that money work harder. Okay, so we've covered a lot of ground today. I mean, we've gone from the Fed cutting interest rates to what that might mean for the stock market, even touched on Bitcoin, and of course, how it all ties back to your own personal finances.
It's been a whirlwind tour of the financial world.
It really has. But that's kind of the point of these deep dives, isn't it? To help connect those dots between like what's happening in the larger economy and what it actually means for, regular people making decisions about their money.
Exactly. It's about giving you the knowledge, the tools to be a smarter investor, navigate all this stuff with, well, a bit more confidence.
Totally. Speaking of confidence, remember that stat we talked about earlier? The one from Schwab about how the S&P 500 usually performs after a rate cut.
Oh, yeah, the 86% success rate? Hard to forget a number like that.
Right. I mean, it just goes to show you there are no guarantees when it comes to the stock market. But understanding those historical trends, that could be huge.
For sure. It's not about like predicting the future exactly. It's
Yeah.
more about understanding the possibilities, right? What opportunities are out there and what are the risks that come with each economic shift.
Exactly. And this rate cut we've been talking about could be a big one. Might be signaling a whole new approach from the Fed when it comes to inflation, and maybe even setting us up for a new phase of growth.
A new phase, new opportunities, especially for those who are ready.
Couldn't have said it better myself.
Yeah.
So, as we wrap up this deep dive, I want to turn it over to you listening. What really got you thinking today? Are you feeling drawn to those dividend stocks we talked about now that rates are lower? Maybe bonds are more your style, that stability, that potential for growth. Or maybe you're feeling adventurous, ready to take on the world of Bitcoin after hearing about, well, the possibilities, but also the risks. Whatever it is, we're here to help guide you on your deep dive. Let us know what you're most curious about, what you want to explore further, and we'll help you navigate it all.
It's been a pleasure diving deep with you all today.
And hey, remember, the world of finance, it never stands still. So stay curious, stay informed, and keep diving deeper. We'll catch you on the next episode of The Deep Dive.